When the most headline-grabbing activist investor takes a concentrated bet, smart money pays attention. When that bet turns into a margin problem, smarter money studies the details. By the end of this video, you will understand exactly why the trap formed and how to use his playbook without copying his risk. But first, let me show you what Ackman is really doing when the cameras are off. Welcome to Alpha Markets, where we decode the market and build your wealth. This story is not about shaming a loss. It is about how leverage can turn a slow stock into a fast disaster. Ackman grew up in New York and learned early that markets reward preparation. He studied business, then launched Gotham Partners, and later founded Pershing Square. His style mixed deep research with public pressure on management teams. Data shows that his best years beat the S&P 500 by a wide margin. But the same record includes sharp drawdowns that tested investor patience. According to SEC filings across many years, Pershing Square has favored concentrated positions. That means a few names can drive the entire result, for better or worse. He is comfortable being early, and sometimes being wrong for a while. Historically, this has meant volatility that looks nothing like an index fund. It also means his mistakes are easy to see in hindsight. Kraft Heinz became one of those defining moments. The company looked like a classic value setup after a merger created scale. It had famous brands, steady grocery demand, and cost-cutting potential. Bulls argued that predictable cash flow could support debt reduction and shareholder returns. Ackman saw an opportunity to buy quality at a discount. His philosophy is simple, but demanding. Own great businesses, buy them at a discount, and push for better execution. He often talks about downside first, then upside second. He is known for saying that concentration is how you get rich, if you are right. What makes him different is the activist layer, where he tries to change the odds. That mindset can work beautifully in stable industries. It can also collide with leverage in a slow-moving consumer staples stock. Margin is borrowed money against your holdings. It can magnify gains, but it also magnifies timing risk. When price drops, brokers can force selling at the worst moment. Now, to be fair, Ackman did not invent margin risk. Retail investors face the same mechanics, just with fewer resources and less flexibility. The trap is that a defensive stock feels safe, so leverage feels manageable. Then one accounting shock or guidance reset can hit, and the whole thesis gets repriced. But here is where things get interesting. Kraft Heinz had signature ingredients that value investors love: strong distribution, scale advantages, and recognizable products. Bulls argue that brand portfolios create pricing power over time. They also point to restructuring that can lift margins. Some bullish analysts saw upside as management simplified the business. In the years after the merger, the market narrative was about efficiency. The company targeted cost savings and streamlined operations. That can raise earnings quickly, which supports a higher P/E ratio. Ackman's team believed the numbers would follow the plan. They also believed the market was too pessimistic about packaged food. The numbers tell a different story once execution meets reality. The company later faced a major impairment charge and scrutiny on accounting assumptions. That kind of event damages investor trust, even if cash flow remains. Bears counter that brand value is not guaranteed in a world of private label competition. They also argue that consumer tastes shift faster than legacy companies adapt. From a market positioning angle, Kraft Heinz still has scale. Yet competition is relentless, from store brands to fresher alternatives. Bears would argue that pricing power is weaker when shoppers trade down. Bulls would counter that scale helps negotiate with retailers and manage supply chains. Both can be true in different quarters. Ackman's big wins show why he takes bold swings. He made strong returns in past campaigns where change unlocked value. He has pushed for better capital allocation and clearer strategy. According to SEC filings, his positions often reflect high conviction and long holding periods. Investors who followed his letters learned how he models cash flows and catalysts. But leverage changes the game. A leveraged position needs not only a good idea, but good timing and stable volatility. Kraft Heinz traded like a sleepy stock until it did not. When the price dropped, margin requirements rose. That can force selling even if the long-term thesis remains intact. Drop a comment. Have you ever used margin, and what rules keep you disciplined? I read every comment. The real lesson is not that the stock was evil. The lesson is that the structure of the bet matters as much as the thesis. Ackman's biggest mistakes are part of his education. He has spoken openly about positions that moved against him. What went wrong in Kraft Heinz was a mix of overconfidence in execution and underestimating sentiment risk. The company's challenges became visible, and the market punished the story. The margin loss turned a paper decline into a realized hit. And that is when the market revealed the truth. In recent quarters, investors have watched consumer staples with fresh eyes. Inflation cooled, but shoppers stayed value conscious. Data shows that volume trends matter as much as pricing. For Kraft Heinz, the debate is whether brand strength can defend share. Bulls argue that innovation and marketing can stabilize volumes. Bears counter that the category is mature and growth is limited. According to SEC filings, Ackman's current portfolio has shifted over time. He still prefers a handful of large positions with clear narratives. He has favored businesses with durable demand and strong management teams. He also watches interest rates closely because leverage costs matter. Investors might consider how their own portfolios react to rate changes. If this analysis is helping you, hit that like button. It helps more people find this content. Now, to be fair, margin is not always reckless. Used carefully, it can be a tool for liquidity or short-term hedging. But the risk here is forced liquidation, not just loss. Before we go further, remember that every investment carries risk. Do your own research before making any decisions. That includes reading broker margin rules and stress testing your positions. A slow stock can still gap down on news. And a diversified portfolio can still suffer if leverage ties positions together. And this is where it gets really interesting. The bull case for Kraft Heinz today rests on fundamentals and patience. Bulls argue the company throws off steady cash flow and can keep paying down debt. They see room for margin improvement through supply chain upgrades. They also point to potential category stabilization as inflation normalizes. Now, to be fair, the bear case is not just about one bad headline. Bears cite valuation concerns if the stock trades like a bond proxy in a changing rate world. They worry that a higher cost of capital compresses consumer staples multiples. They also flag competition, where private label keeps taking shelf space. Macro risks include recession pressure on volumes and retailer bargaining power. Analyst debate reflects that split. A bullish analyst at a major bank argues that brand renovation can support steady earnings growth. A bearish analyst at a research firm argues that growth potential is capped without acquisitions. The numbers tell a different story depending on assumptions for volume, pricing, and marketing spend. That is why conviction without humility can be dangerous. So what can retail investors learn from Ackman's trap? First, separate business risk from structure risk. A good company can be a bad position if leverage is involved. Second, concentration demands deeper research and stronger emotional control. Third, catalysts are not guarantees, and timelines can stretch. How do you apply this without copying an activist fund? Start with position sizing that survives bad weeks. Investors might consider setting personal leverage limits or avoiding margin entirely. Stress test your thesis with bear scenarios, not just base cases. Watch debt levels, interest coverage, and how earnings react to pricing and volume shifts. Compare performance to the S&P 500 to see opportunity cost. But there is one more thing you need to understand. Margin traps often begin with boredom. The stock moves slowly, so investors add leverage to feel progress. Then volatility spikes, and the broker, not the investor, controls the outcome. The safest feeling setups can produce the sharpest forced errors. Ackman's current outlook, based on recent public comments, leans pragmatic. He has emphasized resilient business models and sensible balance sheets. He also watches policy and rates, because macro can overwhelm micro. Bulls argue that disciplined capital allocation can rebuild trust in staples. Bears counter that the market may demand proof for several years. And this changes everything for investors. The goal is not to mimic a famous name. The goal is to understand incentives, constraints, and risk mechanics. If you learn how margin works under stress, you can avoid the silent liquidation spiral. If you learn how narratives break, you can demand a wider margin of safety. The Kraft-Heinz margin loss shows us that leverage can turn a patient thesis into a rushed decision. Share this with someone who needs to understand margin risk and headline-driven drawdowns. Drop a comment. Are you bullish or bearish on Kraft-Heinz and margin use? I read every comment. Hit like if this analysis helped and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down activist investing playbooks and why they matter for your portfolio.